In 1994, a retired postal worker named Ann Schreiber died at age 101. She left behind $22 million. She had never earned more than $3,100 a year. She never got a raise. She never had a financial advisor. What she had was dividends, and she never sold a single share. Most people think investing means buying a stock low and selling it high. That is trading. But there is a completely different game being played by a small group of patient investors, and it does not require timing the market, predicting the future, or staring at charts all day. It requires understanding one simple mechanism: the dividend. When a company earns a profit, it has options. It can reinvest that money into the business, it can buy back shares, or it can pay a portion directly to shareholders. That payment is called a dividend. The beauty is in the simplicity. You own 100 shares of a company that pays $1 dividend per share. That is $100 every single year, just for holding. Most dividend stocks pay quarterly, so that is $25 4 times a year, deposited directly into your brokerage account. Now here's where most people stop reading, and where the wealth builders start paying attention. Imagine a snowball at the top of a hill. It is small, maybe the size of your fist. You give it a push. As it rolls, it picks up more snow. Each rotation adds more surface area. More surface area means more snow per rotation. The snowball gets bigger, faster, and faster. This is compounding. Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he said it or not, the math proves him right. Here is the math that most financial content buries under complicated formulas. You invest $10,000 in a dividend-paying stock with a 4% yield. That is $400 in dividends year one. Instead of pocketing that $400, you reinvest it. You use it to buy more shares. Those new shares also pay dividends. Next year, you do not earn $400. You earn $416. The year after, $433. Small numbers. Boring numbers. But give it 30 years at an 8% total return, and that $10,000 becomes over $100,000. This is not theory. This is the historical record of the American stock market. From 1926 to 2023, nearly a century, the S&P 500 delivered an average return of about 10% per year. But here's what almost nobody talks about. Nearly 40% of that return came from dividends alone, not from price appreciation. From dividends. The companies that consistently paid and grew their dividends, they are the backbone of generational wealth in this country. Let us go back to Ann Schreiber. She started investing in 1944 with $5,000 she saved working for the IRS. She bought dividend-paying stocks in blue-chip American companies. For 50 years, she reinvested every dividend, every quarter. She lived simply. She clipped coupons. She never sold. When she died in 1995, her portfolio had grown from $5,000 to $22 million. That is a 4,400 times return. On a government salary, with no special skills, no connections, just time, dividends, and patience. So how do you actually do this? The first step is understanding dividend quality. Not every dividend is created equal. The most prized category is called the dividend aristocrats. Companies in the S&P 500 that have increased their dividend payment every single year for at least 25 consecutive years. Think about what that requires. Surviving recessions, pandemics, interest rate shocks, oil crises. These companies did not just pay dividends, they grew them through everything. Companies like Procter & Gamble, Johnson & Johnson, Coca-Cola, and Colgate-Palmolive have raised their dividends for decades, sometimes over 60 consecutive years. The second key is DRIP, Dividend Reinvestment Plans. Almost every major brokerage now allows you to automatically reinvest your dividends without lifting a finger. You enable the setting once. Every quarter, instead of cash hitting your account, new shares are purchased on your behalf. It is automation working in your favor. You are not making decisions. You are not checking the news. The machine is running, compounding quietly in the background while you live your life. Here is the uncomfortable truth about investing. Most people are their own worst enemy. The average retail investor dramatically underperforms the market, not because they pick bad stocks, but because they panic and sell at the bottom. They trade based on headlines. They check their portfolios every hour. They feel the market is fear. Dividend investing gives you a psychological edge because it fundamentally changes what you are watching for. When the market drops 30%, the trader panics. But the dividend investor asks one question: is the company still paying its dividend? If Coca-Cola drops from $60 to $42 a share, they are still paying that $1.84 annual dividend. In fact, now your money buys more shares per dividend payment. The price drop is now your friend. This inversion of perspective, treating market volatility as opportunity rather than catastrophe, is worth more than any stock-picking formula. Let us bring this full circle. The dividend snowball is not a get-rich-quick scheme. It is a get-rich-slowly strategy that has worked for over 100 years. You start with whatever you have. You buy quality companies that pay and grow their dividends. You reinvest automatically every quarter, forever. You do not panic. You do not sell. You do not watch financial news every morning. You let time do the heavy lifting. Ann Scheiber understood this. Warren Buffett built a $100 billion fortune on versions of this principle. And you can start today with whatever you have in your account. If this video gave you a new way to think about building wealth, I want you to do one thing right now. Hit that subscribe button and ring the notification bell. Every week on Market Mapped, we break down exactly how the money works. In investing, in dividends, in the stories of people who built real wealth from nothing. No noise, no hype, just the real mechanics of how wealth is created. I will see you in the next one.